Welcome to Tikona Capital's comprehensive market outlook for January 2026. We are driven by deep research built on strong networks and act with conviction. Our mission is clear: to empower you to invest in high-quality businesses and build sustainable long-term wealth. Let's explore what lies ahead. At Tikona Capital, we provide comprehensive wealth solutions tailored for working professionals, HNIs, and family offices. Our offerings include equity model portfolios, mutual fund solution, differentiated PMS, unique AIFS unlisted equities, startup investment, IPO advisory. Everything you need under one roof. Before we begin, important disclosures: Tikona Capital is SEBI registered as a research analyst. Investments in securities are subject to market risks. Please read all documents carefully before investing. This presentation is for educational purposes only and should not be considered as investment advice. After a year of reset and relative underperformance in 2025, we enter 2026 with a more supportive macro backdrop and clearer policy visibility. India's economy remains resilient in a slowing world, domestic liquidity is strong, and valuations have cooled closer to long-term averages, which means the next phase of returns will increasingly depend on earnings delivery, sector selection, and disciplined portfolio construction. In 2025, Indian equities lagged global markets as rich starting valuations, slower earnings growth, and policy lags caught up with price performance. This phase of underperformance is less about a structural break and more about time correction, where markets gave back some excesses while waiting for earnings to catch up. That reset, while uncomfortable, creates a healthier base for more fundamentals-driven returns in the coming years. The United States is undergoing a strategic reset in its economic model, shifting focus from consumption, financial assets, and cheap imports toward investment, manufacturing, and domestic capacity building. Currency strength is being questioned, trade policy is now used as a geopolitical tool, and fiscal incentives increasingly favor producers and strategic sectors. This transition may slow global demand at the margin, but it can also rebalance risks and opportunities across regions over the medium term. The global tariff cycle has clearly turned, and China is at the epicenter of this shift, facing higher trade barriers and rising scrutiny across many markets. While trade risk has increased globally, India remains relatively insulated, thanks to a more balanced trade profile and growing domestic demand. For investors, this means staying mindful of global supply chain disruptions, but also recognizing that India's exposure to severe trade shocks is more limited than many peers. Global trade volumes are sending mixed signals. Some regions are stabilizing, while others continue to see weak exports and soft imports. This uneven landscape suggests that a broad-based, trade-led global upcycle is unlikely in the near term. Instead, investors need to focus on economies where domestic engines, consumption, investment, and policy support are strong enough to offset external softness, and India stands out favorably in that context. Global growth is slowing and bond demand is constrained, creating a funding gap for governments. Developed markets may gradually move back toward some form of quantitative easing to keep borrowing costs in check, but liquidity alone will not guarantee strong real growth without genuine credit and investment demand. India economy. Compared with 2025, the macro setup for 2026 looks more balanced and supportive. Global and domestic rates are closer to neutral, capex is trending above long-term averages, and India's tax, GST, and regulatory reforms keep policy accommodative. Together, these drivers can support a more durable, investment-led growth cycle. India stands out as a resilient large economy, combining healthy real and nominal GDP growth with contained inflation and manageable deficits. The rupee has adjusted in an orderly way despite global volatility, and policy choices remain pragmatic. This mix of growth and stability provides a strong base for long-term investors. Reforms in 2025 focused on making the system simpler and more predictable rather than just announcing big slogans. Tax and GST rationalization reduce friction, labor and MSME changes improve flexibility and credit access, and rural plus export measures broaden participation. Over time, this combination can lift productivity and support more inclusive growth. Macro stability is becoming India's key strength. Inflation is broadly under control, external balances are manageable, and fiscal discipline supports investor confidence. This gives policymakers room to respond to shocks while still pushing structural reforms. For investors, it means future growth is likely to be of better quality, not just faster. We now move from the big macro picture to the debt market lens. Here, growth, inflation, fiscal settings and RBI decisions on rates and liquidity will shape bond yields and spreads. Understanding how domestic investors, foreigners and the currency interact becomes crucial for building sensible fixed income and asset allocation strategies. Gold has shown its value as a portfolio hedge, delivering strong returns in recent years when markets faced policy shifts, inflation scares and geopolitical noise. It tends to shine when uncertainty is high and risk assets wobble. A calibrated allocation to gold can help preserve capital and smooth portfolio drawdowns across cycles. The oil and gas market is being pulled in two directions. Trade tensions and tariffs are raising costs and delaying projects across the value chain, yet demand from large emerging markets and ongoing geopolitical risks keep crude fundamentally supported. This pushes companies to rethink capex, diversify sourcing and protect margins more aggressively. 2025 was less about dramatic rate cuts and more about how central banks, especially the RBI, managed system liquidity. Aggressive infusions and targeted operations kept yields relatively range-bound despite supply and currency pressures. For investors, the conversation shifted from how low can rates go to how effectively does liquidity reach the real economy. After cutting policy rates by about 125 basis points as inflation cooled, the RBI is now closer to the end of its easing cycle. Any further cuts are likely to be modest and data-driven. The focus moves towards stability, transmission and liquidity tools, making it important for investors to balance duration with accrual and credit quality. Foreign portfolio flows have become more tactical and volatile, especially in debt, while bond supply remains large. Domestic investors and institutions are increasingly the key stabilizers absorbing this supply. At the same time, the rupee continues to act as a shock absorber, adjusting with global dollar moves but avoiding disorderly swings that could unsettle markets. We now turn to the equity side of the story. Index headlines only reveal part of the picture. Underneath, there have been sharp differences between large caps and smaller caps, sectors and styles. Understanding how leadership is shifting and where returns are actually being generated is essential for smart equity and fund selection. Mutual fund data for December 2025 highlights how diversification pays. Equity categories like value, contra and mid-caps have delivered strong 3-year returns, while small caps faced near-term pressure. Hybrid funds benefited from powerful gold and silver moves, and debt funds quietly compounded in the 6-7% range, with credit-oriented strategies providing extra carry. Indian indices were broadly range-bound in December, with modest gains at the headline level but visible pressure in mid and small caps and SME IPOs. Sector performance was highly selective, commodities and a few themes did well, while others lagged. Globally, markets like Nasdaq and key European indices remained resilient over 3 years, reminding us that leadership also rotates across regions. The flow and primary market data tell a powerful story. Even as FIIs oscillated between heavy selling and buying, domestic institutions and SIPs stayed strong. Mainboard and SME IPOs raised record capital with healthy oversubscriptions. This depth of local capital is increasingly what allows India to fund growth and absorb volatility. Nifty's path through 2025 was anything but linear, swinging with earnings disappointments, tariff headlines, budget expectations and rate cut announcements. GST rationalization and liquidity support helped offset some of the shocks. By the end of the year, with reforms in place and early FY26 earnings upgrades, the market rested on a more sustainable footing. One of the most important structural changes is the rise of domestic flows. SIPs, mutual funds, insurers and pension money are increasingly setting the tone for markets. Fee-led sell-offs now often become opportunities rather than panic points, especially as investors look ahead to an earnings-driven recovery in FY26 and FY27. Investment strategy. We expect growth to improve in 2026 as the lagged impact of GST cuts, tax relief and rate easing finally shows up in the real economy. Consumption stabilizes and begins to accelerate, especially in urban pockets, and confidence indicators turn up. In a world where global growth is slowing, India's relative position strengthens, attracting more capital and business activity. The next global capex cycle is being shaped by supply chain diversification and friend-shoring. India emerges as a key beneficiary thanks to its large market, reform momentum, and attractive cost base. This creates selective opportunities across manufacturing, infrastructure, logistics, and allied sectors that stand to gain from both domestic and global investment flows. After years of elevated valuations, 2025 underperformance brought some much-needed compression. Nifty now trades closer to its long-term average multiples, even as market cap to GDP remains high. This is healthy. It means that future returns will depend much more on earnings growth, balance sheet strength, and capital allocation than on sheer re-rating. The earnings cycle is expected to take the baton from valuations in FY 26-27. After a muted 2025, consensus sees a double-digit recovery led by financials and autos, with easing input costs supporting margins. Importantly, the breadth of earnings growth should gradually widen beyond a narrow set of leaders, creating more bottom-up opportunities. At a sector level, we are constructive on autos and auto ancillaries, banks and select NBFCs, and healthcare and specialty chemicals where structural tailwinds are strong. Metals and parts of cement look more sensitive to valuations and cost swings, calling for caution. Technology offers optionality as a later cycle beneficiary once global demand and its spending pick up. Artificial intelligence has become a powerful global theme, and in some markets it has pushed valuations far ahead of present cash flows. India's IT sector, however, is still largely grounded in proven earnings and strong balance sheets. Over time, sustainable cash generation, not just AI narratives, will determine which companies create lasting shareholder value. 2025 was essentially a year of adjustment, slower global growth, higher tariffs, policy easing without matching earnings, and valuation compression in India. In contrast, 2026 is shaping up as a year of execution, policy lags turning into tailwinds, earnings recovering, leadership broadening, and domestic flows dominating market structure. Two big themes stand out for 2026. First, discretionary consumption, supported by GST cuts, better affordability, and improving rural wages and confidence. Second, financials, where credit growth is accelerating, retail and housing loans remain key drivers, and asset quality is holding up well, creating a healthier, more sustainable credit cycle. Stepping back, global growth is likely to remain patchy and heavily influenced by policy moves. Yet India's macro dashboard, anchored inflation, improving fiscal discipline, manageable external balances, and robust GST collections, looks relatively strong. A stable to soft rupee further supports exports and manufacturing, giving policymakers and investors useful flexibility. From an income perspective, we favor accrual-oriented, short to mid-duration strategies with disciplined credit selection. In equities, we see returns becoming more earnings-driven as valuations normalize. Gold remains an important hedge, and an orderly, gradually weaker rupee supports export earnings without destabilizing macro metrics, making a multi-asset approach very relevant. In our curated ideas, we highlight multi-asset and flexi-cap mutual funds that have consistently outperformed category averages, helping investors participate across assets through a single vehicle. On the fixed income side, we focus on a high-quality, R-rated, short-tenor bond that offers attractive yield for conservative investors seeking better risk-adjusted carry. For investors with higher risk appetite, we add satellite ideas such as Nifty-linked market-linked debentures with defined payoff structures, and marquee unlisted names like NSE and Zepto. These can complement a strong core portfolio, but require thoughtful sizing, careful due diligence, and comfort with liquidity and valuation risks. We invite you to download Tikona Capital app today, available on both iOS and Android. This is your one-step solution to track all your investment across asset classes, mutual fund, equities, debt, gold, real estate, and more in one comprehensive place for you and your entire family. The app features easy self-onboarding requiring just a few basic details to get started. Completely seamless and paperless with no long form or hassles. You will get a complete 360-degree portfolio view providing a comprehensive picture of all your investments at any time along with smart AI-driven insights to help you make better, more informed decision-making with real-time updates and actionable recommendation. This is your Investing Sarthi, a book for investors who want clarity instead of noise and tips. Inspired by Krishna guiding Arjuna, it helps you navigate volatility, emotions, and endless choices in markets. Packed with practical, real-world frameworks from our research and client work, it sharpens how you think about risk, allocation, and wealth creation. If you connect with our conviction-driven philosophy, this book is the natural next step in your investing journey. Thank you for your time and attention. At Tikona Capital, our philosophy is driven by creating finite, actionable solutions within an environment of infinite availability and volatility in financial products. The triangle in our logo represents this finite filtering, removing the unknowable edges from the circle, which symbolizes the ultimate unknowability of nature and markets. We're ready to explore these finite solutions in infinite possibilities together with you. Connect with us. Visit our website at www.ticonacapital.com. Explore our small case portfolios at ticonacapital.smallcase.com. Follow us on LinkedIn at linkedin.com/company/ticonacapital. Subscribe to our YouTube channel, read our blog for deeper insights, or reach out directly to our founder and CIO, Sumit Poddar, at sumitpoddar@ticonacapital.com. Let's build your wealth together with research, network, and conviction.